Good morning and welcome to the Commodities Institute podcast. I'm Emily Costa and today is Tuesday, February 3rd, 2026. Energy politics are colliding with trade policy, metals markets are swinging wildly, and agricultural supply chains are feeling pressure from both price collapses and policy disputes. So let's take a breath, settle in, and make sense of it all together. I want to start with oil because a geopolitical shift is quietly building that could redraw crude trade flows in a very real way. India, which over the past few years became one of the largest buyers of discounted Russian crude, may be heading toward a gradual halt in those purchases. This comes after a new trade understanding between Washington and New Delhi that includes lower US tariffs on Indian goods in exchange for changes in India's trade posture, and that reportedly includes scaling back Russian oil imports. Now, this is not a flip-the-switch situation. Indian refiners have cargoes already booked, some loading in February and arriving in March. Refining systems are complex, and crude slates are carefully balanced. You cannot just swap one grade for another overnight without technical and economic consequences. So what we are likely to see is a wind-down period rather than an abrupt stop. Still, the direction of travel matters. If India steadily reduces Russian barrels, those flows will need a new home, and India will need replacements. The United States is an obvious candidate, particularly with its growing export capacity. Venezuela is also being discussed as a possible supplier again, which adds another layer of geopolitical complexity. The big picture here is that politics is once again reshaping physical oil trade routes, and that tends to create price dislocations, freight shifts, and regional margin changes for refiners. Staying in the oil patch, but shifting to the corporate side, we've got a major consolidation story in US shale. Devon Energy and Coterra Energy are merging in an all-stock deal that creates a company with an enterprise value of roughly $58 billion. That makes this one of the largest upstream tie-ups in recent years. Why now? Because scale is becoming a survival strategy. US shale producers are facing thinner margins as global supply looks comfortable and prices remain under pressure. By combining, these companies expect to cut costs, optimize drilling across overlapping acreage, and generate about $1 billion a year in pre-tax savings by the end of the decade. They are also promising stronger shareholder returns through dividends and buybacks. What is especially interesting is the focus on the Delaware Basin, part of the broader Permian. The combined company will control a massive position there with years of drilling inventory that can break even at relatively low oil prices. In a world where investors are demanding discipline rather than pure growth, that kind of low-cost inventory is gold. And yes, we'll get to actual gold in a moment. Before we leave energy, we need to talk about natural gas, specifically liquefied natural gas. There has been a long-running narrative that the world is heading for a glut of LNG later this decade as big projects in the United States and Qatar come online. But now we are hearing a counter-argument that demand from artificial intelligence infrastructure and data centers could be so strong that what looks like oversupply today might turn into shortage by around 2030. Think about the scale. Data centers are incredibly energy intensive, and as AI adoption accelerates, electricity demand rises with it. Add to that continued gas use in Asia, Europe's structural need for LNG after cutting back on Russian pipeline gas and growing use of gas in transport and industry, and suddenly the demand curve looks steeper. If that plays out, the LNG market could tighten again just as new capacity settles in, which would be a major shift for long-term pricing expectations. Let's move to metals, where the drama has been impossible to ignore. Gold and silver just went through one of the sharpest two-day sell-offs in decades. Gold plunged after a huge rally that had taken it to record highs, and silver saw an even steeper percentage drop. The trigger appears to have been a mix of policy signals and technical factors, including higher margin requirements in futures markets. But here's the key. Many analysts do not see this as the end of the bull run. Instead, they describe it as a violent correction after an overextended rally. Expectations for interest rate cuts later this year, ongoing geopolitical risk, and steady central bank and investment demand are still supportive for gold over the longer term. Some forecasts are already talking about new record highs later this year, even after this dramatic pullback. So volatility, yes. Structural collapse in the gold story? Not the base case for many in the market. Now let's shift gears to agriculture, where we are seeing both demand shifts and serious stress. In vegetable oils, India's imports of palm oil jumped sharply in January, hitting a 4-month high. The reason is straightforward economics. Palm oil has been trading at a sizable discount to soy oil, and Indian refiners are highly price sensitive. As a result, they boosted palm purchases while cutting back heavily on soy oil and sunflower oil. That matters not just for India, but for producers in Southeast Asia and oilseed markets in the Americas and the Black Sea. Meanwhile, in West Africa, the cocoa market is facing a policy standoff. Processors in Ivory Coast are pushing back against the cost of beans for the upcoming mid-crop and are asking for tax relief and changes to pricing mechanisms, including the so-called living income differential designed to support farmers. Global cocoa prices have fallen sharply from their peaks, and exporters and processors say current cost structures are no longer workable. The government is now under pressure to respond, and any decision will have ripple effects through farmer incomes, export flows, and global chocolate supply chains. Finally, a quick note on bulk trade. Taiwan has stepped into the market to buy a substantial volume of US wheat in a recent tender, while Ukraine's agricultural exports held steady month over month despite ongoing logistical challenges. These flows are reminders that even amid geopolitical tension and price swings, the steady movement of staple commodities continues. Ships load, cargoes sail, and food systems keep running. So what ties all of this together? Adjustment. Trade routes are adjusting. Companies are adjusting through mergers. Markets are adjusting after extreme price moves, and policymakers are adjusting to social and economic pressure in producing countries. Commodities are never static, but right now the pace of change feels especially fast. That's why staying informed and staying calm really matters. If you found this episode valuable, be sure to subscribe, share, and leave a review.